Yeah, ladies and gentlemen, welcome to my fourth lecture, Research in Financial Markets. The paper that I would like to discuss with you today is entitled Return Dispersion, Risk in FX Markets and Global Equity Markets Doesn't Explain Currency Momentum. So I started to work on that paper. If you scroll down a little bit, you might have recognized that I started to work on that paper already in 2015. So the first draft was ready in 2015. Then it has been circulated around. We have presented this paper on different conferences, as you see here. And we got comments in order to improve our manuscript. And then it has been published last year I think it was in spring. So what's the story here in this paper? So, according to Gomez, Koren, and Zhang, the 2003 paper, and Zhang in the 2005 paper, they argued that return dispersion or cross-sectional return dispersion represents a macroeconomic state variable related to investing conditions faced by firms. Yeah, there's a study from 2010, Stevens and Son. And they investigate or they establish a link between cross-sectional return dispersion in equity markets and equity momentum payoffs. Yeah? So the purpose of this study is to close the gap in the literature between equity and currency market research by investigating the role of cross-sectional return dispersion in foreign exchange markets and FX markets and currency momentum payoffs. So if you see in section 2, we provide a brief literature review. Yeah? So you might remember from earlier lessons here that we discussed momentum in equity markets. And if you remember this timeline, yeah, let's say today we are at time t0, then we have t plus 1, t minus 1, and so on, t minus 12. And then we remember from earlier classes that the standard strategy in equity momentum is that you basically sort stocks based upon past performance from t minus 1 until t minus 12. Yeah? You sort them from losers to winners. Yeah? Then you short sell the loser stocks and you buy the winner stocks. Yeah? You keep these 1 month ahead. Yeah, in the holding period, 1 month ahead. And then you do the same thing again. Yeah? So you just move the time window in the next asset allocation period 1 month ahead. And then you do the same thing again. Yeah? Pretty simple. So most papers, I would say, use this standard strategy for equity markets. But every asset market has somehow their own or the sort of an individual momentum strategy that works out the best. Yeah? So for instance, in the currency market, if you check section 2, most papers, they employ a 1-1 strategy. Yeah? So basically where you have your currency portfolio, you have your universe of currencies, and at the first asset allocation, let's say we are in T0, you sort all currencies in your currency universe based upon the most recent, the previous month's return. And then you sort them based upon the previous month's return from losers to winners. And then you short sell the loser currencies and you buy the winner currencies and you keep them 1 month ahead. So the holding period, again, 1 month ahead. So it's a momentum 1-1 strategy that most papers employ that study the momentum effects in the foreign exchange market. So it's different somewhat from the equity market because the most recent month we skip here. And that's basically our conditional, that's the month where we condition our sorts upon when we implement the strategy in the foreign exchange market. Yeah. So the data we use, we download the data from Adrian Werdelhan's online library. Luckily, there are many researchers nowadays that provide the data in the online library, like Kenneth French library, which we already have encountered in this course. And Adrian Werdelhan, he is a researcher who is strong in the currency market research, and also he provides an online library where you can download data. Yeah? So we use, from his data library, we use a total of 39 currencies, denoted in US dollar, of course, over the period from February 84 to January 2010. Unfortunately, his data set ends in in January 2010. Yeah. So in table 1, we have the descriptive statistics. If you scroll down here in table 1, you see sample average, standard deviation, skewness, kurtosis, and so on and so forth. Yeah. So of the currencies that we have in our sample. Yeah. So we use these 39 currencies, and we compound the cross-sectional return dispersion for the currency market as in this formula 1. Yeah. So here you see the cross-sectional return dispersion at time t. And the formula that you see here, we use portfolios sorted by carry, which means, okay, we have our 39 currencies, and we sort them based upon the previous month's interest rates. Yeah, so we have and then we form 6 portfolios based upon our 39 currencies, and based upon the previous month's interest rates. Yeah? And you might have heard about this carry strategy. Yeah? This is a strategy that buys currencies that have in countries that have a high interest rate, and short sells currencies of countries that have a low interest rate. Yeah? So, and what we see here is the mean of our 6 portfolios here, and then we have every portfolio, yeah, we subtract the mean, we square it, and then we sum it up over our portfolios here, and then we divide it by the number of portfolios. So this is nothing else than the formula for a standard deviation. Yeah? Just now, we don't take it over the time dimension, but we take it over the dimension of portfolios given each point in time. Yeah? So it's a cross-sectional standard deviation. And instead of portfolios as input assets or as inputs for our estimator for the cross-sectional return dispersion, we could also use the currencies themselves. Yeah? So then we would have, then n would be 39 instead of 6. Yeah? We could use, and then what we would have here is we would subtract the sample average of our 39 currencies for each point in time by the corresponding return for each currency in each point in time, and then we would square it up, we would sum it up over our 39 currencies given time t and take the standard deviation. Yeah? So there are different ways how to estimate the cross-sectional return dispersion. Some papers, they argue for it's better to use portfolios because the process is a little bit smoother. Other papers, they say, no, we need to have the entire set of assets, and they use the whole universe of assets. So there are different papers. We decided to use portfolios sorted by carry. Yeah. So what you do then is, once you compounded the time series of these of our portfolios, yeah, the process will look a little bit like this. So RDT, so return dispersion at time t, depending on time. Yeah? And then you have a process that has peaks and lows. And what you do then in the literature, they're smoothing this process, and they take the 3 months moving average. And this is in our paper denoted as RD13 for time t. So we take the average of the 3 months. a rolling time window basically. So in order to smooth the process, we operate with the 3-month moving average of this formula here, which means in essence that we, of course, lose the first 2 observations then, right? So the sample that we use then for our measure of cross-sectional return dispersion, or the 3-month moving average of cross-sectional return dispersion, has, of course, then 2 months less of the sample. In our study, we want to establish a link, or that's basically the idea, is that cross-sectional return dispersion has been linked to momentum payoffs in the equity market. Yeah? And there are studies, we'll come back later to that, or soon, that basically argue that this, based upon the CAPM model, they derive a theoretical framework for why cross-sectional return dispersion in equity markets may be a macro state variable, capturing macroeconomic risk. Yeah? But this is only valid actually in the CAPM framework. And the CAPM is derived for stocks, not for currencies, for firms. Right? So currencies are a different type of assets, right? But the idea is that we had that if cross-sectional return dispersion is a macro state variable, it should be also reflected as a risk component in the currency market. But the corresponding measure for cross-sectional return dispersion or cross-sectional volatility in the currency market is, of course, given by this formula here. Yeah. Or this is just one example. But we need to have inputs here that are related to the currency market. So, but in order to show, or in order to establish a link between cross-sectional return dispersion in the currency market and the equity market, we need, of course, a proxy for both series. So our measure for the currency market is given by equation 1 here that we just were talking about, and for the corresponding measure for the global equity market, we followed the paper from Maio, the 2016 paper. Yeah, Paolo Maio is an extraordinary great researcher here in Finland from Hanken School of Economics. This guy publishes in the top journals basically all the time. So we downloaded 25 value-weighted global equity portfolios sorted by size and book-to-market ratio, and which data library do we use? Of course, from Kenneth French. So all portfolio returns are denominated in US dollar, which makes things simple because our currencies are also denoted in US dollar, right? Using this data series, the cross-sectional global equity market return dispersion is then computed according to this formula here. Yeah? Then L, we have 25 portfolios, so L is 25. And for each point in time, yeah, we estimate the standard deviation across these 25 value-weighted global equity portfolios. Yeah? Very, very simple. Then again, in order to smooth the process, yeah, we take the 3-month moving average of this formula here, yeah? Which means, again, that we lose the first 2 observations of the time series in order to smooth the process. And in doing so, this is not our own idea. Of course, we followed the literature on that. So we can skip formula 2 and 4. Yeah? These are just other versions where we basically somewhat orthogonalize this measure. But for this lecture, this is not so interesting for us. So since the data for the global equity data starts in September 1990, we match both samples. Yeah? So the sample that we operate with in the study here starts in September 1990 and ends in January 2010. So roughly 20 years of data. again, as we already spoke about, we use this momentum 1-1 strategy that we have derived here. What happens here? So yeah. And in table 2, we report the descriptive statistics. Yeah? So what we see here is once we move from loser to winner currencies, we see that the spread is linear increasing as we move from winner to loser, from loser to winner currencies. Yeah? Loser currencies have a monthly average payoff of minus 0.19%, whereas winner currencies have a positive monthly payoff of 0.54%. Yeah? Our zero-cost strategy is then 0.54 plus 0.19, which is something like 0.70 or 73 basis points per month. If we have a look on figure 1, in figure 1, we see the cross-sectional currency return dispersion, and what we also see here, we highlight the 10% of highest values of cross-sectional return dispersion in the currency market. So again, we use formula 1, or the 3-month moving average of formula 1, yeah, based upon currencies. This is our measure for cross-sectional return dispersion in the currency market using carry solid portfolios. So, and that's basically what we get out. Yeah? This is our measure, as I have basically written here already on the whiteboard. So we see periods of high cross-sectional return dispersion in the currency market, yeah, and we see periods of low or relatively low cross-sectional return dispersion in the currency market. Very similar to what we observe as well in equity markets. So if we see those 10% highlighted cross-sectional return dispersion states, yeah, we match them with corresponding economic events. And for instance, here in the 2008 period, where we had a peak in cross-sectional return dispersion, it coincides with the bankruptcy of this huge investment bank, Lehman Brothers, and during the financial crisis period, where everything went completely crazy. In the late 90s, this was probably years before your time, but we see here the Asian crisis, also an economic event that somehow had an impact on the world economy, and we see again peaks in cross-sectional return dispersion in the currency market. In the early 90s, we had the recession in the USA and in the UK and continental Europe, including Finland, as far as I'm concerned. And also here we see peaks in cross-sectional return dispersion in the currency market. And here in the mid-80s, the oil price collapse. Also, again, it coincides with peaks in the cross-sectional return dispersion in the currency market. So obviously, what we see is that the cross-sectional return dispersion in the currency market, obviously, that whenever this measure is high or has peaks, it coincides with economic stress, which somehow supports the idea that we had in the beginning that economic risk that is reflected in the currency market and in the equity market, they should be somehow linked to each other. Yeah? Again, in section 4, we do our empirical analysis here. It starts with section 4.1, currency return dispersion and global economic risk. I told you already that the idea is basically based upon earlier research, in particular this paper from Titania, the 2015 paper, who argued that return dispersion, and they talk about equity market return dispersion is likely to capture the uncertainty associated with economic transitions and the flexibility and adaptability to fundamental economic restructuring. And this has been, if you go through the paragraph here, there are other papers that actually say or argue in a similar way. And the 2003 paper from Grobys and his colleagues, they have derived actually the theory. Here's the theory behind these empirical arguments. But again, the theory is based upon the equity market. So now the question is, how can we now show that the risk in the equity market and in the currency market share a common driver? How can we show that? That was the first step of that paper. We wanted to show, or we wanted to figure out if risk in the currency market and in the equity market share a common driver. And in figure 2, we plot the time series of cross-sectional equity return dispersion and cross-sectional currency return dispersion over time, over our sample period, starting from 1990 to 2010. So the dotted line here denotes our cross-sectional currency return dispersion, and the black line here denotes the cross-sectional equity return dispersion. And what you can see already from visual inspection, that they somewhat co-move. And now we need to talk about a little bit about statistics, or actually you should know this already from statistics class or from econometrics classes. So let's talk for a minute about OLS regression, because OLS regression is usually our main tool in empirical analysis, right? So let's say we have a variable y, t, and we have a simple regression model. We have an intercept term here, and we regress it on another variable xt, and then as is always the case in regression models, we have also an error term. And you know from econometrics, the error term is usually assumed to be normally distributed with zero mean and standard deviation of 1. So some assumptions. So in the standard regression model, you can only use OLS actually if our regressors, if the regressor and the dependent variable, if they are stationary. So what we need is we need variables. Let's say this is our timeline for yt, depending on time t, and here we want to plot our variable xt depending on t. So we need to ensure somehow, or we need to know, before we can run this model, we need to ensure that these two variables here, that they are somehow circulating around a mean. And the same is true for our x variable. So what we want is, okay, the variable should be somehow circulating around a mean. What we do not want is a variable. I will give you now an example that we do not want. That's a variable zt. We do not want a variable that looks like this. This variable has bumps everywhere. That's a random walk. It's like a stock price. It moves around like it wants. Sometimes it moves up, and at some point it moves down, and you never know when it moves down. And so this is a process that is hard to predict. It's like a random walk. So we do not want that. So we need somehow to test that our variables that we use in our regression model, that they satisfy this condition that they are stationary, so that they are fluctuating around a mean, that they are that the correlation basically is not like increasing over time or something. So we want to have a white noise process, a white noise process, a process that is erratically moving around a sort of a mean. With constant variance over time, and so on, so that our standard assumptions are satisfied. So if this is the case, if this process looks like this, what we get out of this, if we would run the OLS regression, and one of our variables would look like this, or would be a random walk statistically, our point estimates are completely nonsense. It's bullshit. Yeah? So people who do that, they have no idea what they actually are talking about. So you have to satisfy that the process is stationary. And there's one statistical tool that you hopefully have learned in econometrics class, and which is the ADF test. Yeah? So every variable, like, let's say x and y, so you have to basically, it's a regression, but if you use eViews, in eViews they have this button that you just push, ADF test, and then you have to determine which kind of ADF test you want to use. Then you just push the button and eViews spits you out what it is. But what it is in essence, you can also do it manually, of course, or in MATLAB or in R if you like R. So what you do is you regress the difference of each variable on the lagged variable, which is not differenced, including an error term, of course. That's the ADF test without any deterministic terms. Then you can also, as an alternative, you can regress the differences of y on the same, yeah. So you regress it on the lagged variable in levels, and then you have a phi. This is the point. This is the parameter that you're interested in. Now you include a c, which is a constant term, and again we have this error term here. And then, if you want, you can also the third possibility is that you regress the differences of yt on, again, the variables in levels, lagged plus c plus, let's call it delta t, which is a time trend, plus an error term. So what you do then in all of these is actually you're interested in this parameter here. The parameter that is associated with the variable and levels lagged. Yeah, that's basically the idea of the ADF test. What you do then is, okay, depending on your model specification or test specification, you check the t statistic of this guy here, of this phi, and then there's this table, the standard table that every econometrician uses here, yeah, and then you would compare, let's say you have 500 observations, then you would check, okay, you want to have a significance level of 5%, then we are in the second column, 0.05, 500 observations. So you would test, and if you have no deterministic terms, that means you have this equation here, you would test if this guy here is smaller than minus 1.95. If it's smaller than minus 1.95, this guy here is stationary. Then we have this process. Then everything is all right. So, and if we use this model here, if you have a deterministic term here, a constant term, this guy here should be smaller than, what do we have here? Minus 2.87. Given, again, we have 500 observations, and we use a level of 5% for our test. If we use this guy here, this model here, this ADF test model, where we have in the regression equation the constant and the time trend, yeah, and we have 500 observations, and we use a 5% significance level, then this guy here, this point estimator, or the t statistic of this point estimator should be below minus 3.42. If it's below minus 3.42, then we know, okay, our input variable is stationary, and we can run our OS regression or whatever regression we would like to run. Yeah, so that's the idea of the ATF test. Yeah? We have to ensure that somehow our input variables are stationary. So there is one exception where you can do the OLS regression even though the input variables are random walk. And this is called co-integration. Has anyone heard about the concept of co-integration? Maybe in my colleague's course. So let's say we have a variable. Here we have z. Let's call it now for zt1. Yeah? And we have another variable. Let's call it, let's take a blue pen here, and zt2. Yeah? If our zt2 would look like this, what you see visually is that both processes, they are random walks, obviously, so they have bumps everywhere. They are both not erratic like this guy, but they co-move in the same direction. So when one of them peaks and moves up, the other one moves up as well, with a little time lag here and there. But they move stochastically in the same direction. When one moves down, it doesn't take much time, then the other one moves down as well. And if one of them moves up, it doesn't take much time, and the other one moves up as well. So they are co-integrated. Now they move in the same direction. They share a common stochastic component that ties these two time series together in the long run. That is the concept of co-integration. If two processes are co-integrated, you can run OLS regression, and all your point estimators are valid. That's the only exception. So the thing is, this was just a small excursion. So the point was in our analysis here. If you see figure 2, from figure 2, it is not evident if we have a random walk here or if it's stationary. It's not self-evident, so we have to make a test. So we have to ensure that statistically we are operating either with stationary time series or that they are co-integrated. So, and depending on if we have this case here or that case, we have to choose the corresponding methodology. So we use different methodologies in these cases. So what we did is, okay, we were testing these two time series here, our 3-month moving average of cross-sectional equity return dispersion and currency return dispersion. And what we figured out is, okay, given the sample period, both processes are random walks. But we have not shown yet. Now we have to show, okay, if they share a common stochastic driver, then they should be co-integrated. So what we have to show now is that they actually move in the stochastically share, that they move in the same direction, and that they are in the long run tied together. And this is what we have done here. So we employed the so-called Johansen test or Johansen trace test procedure for co-integration, and it's based upon an eigenvalue problem, and we have to use a vector autocorrection model here, which is it's not that complicated, but there are easier procedures, of course. There are easier ways to test for co-integration. If you have just two time series, as we have here in this case, there's a much easier way how you can ensure that your processes are co-integrated. Yeah? And this is basically what we want to go through just briefly here. So, and this is basically what we have already done. So, what we do is, let's say YT is the cross-sectional, is the 3 month moving average of the cross-sectional currency return dispersion, and XT is the 3 months moving average of the cross-sectional return dispersion for the equity market. Yeah? So the first step would be, you would run this regression without an intercept term. And the second step is, now you take the residuals of this regression here, and you regress the differences of the residuals, which is in essence ET minus 1. That's the difference in residuals. You regress it on the lag residual times t minus 1, and an error term, which we have now to denote, of course, in a different manner. Let's call it UT. Yeah. And then again, now, if these processes are co-integrated, like we have here, this guy here, our residual term, should be stationary. Now we test the residual term, and not the input variables. Okay. Now we test the residual term. So we do the same test, but we use the residuals. And again, we have 3 different tests. Either we don't use any deterministic term, or we use an intercept term only, or we use intercept and time trend. Yeah? So it depends on our assumption, and it depends on the data, of course. And again, if our phi, if this guy here, under the null hypothesis, we assume it's a random walk. Yeah? So we say, okay, this guy here is 0. Under the alternative hypothesis, H1, phi is smaller than 0. So again, we have to have a look on the phi, depending on which model we use. So and then, this time we use different reference statistics. So you see the values here, if you compare the values from table 6 with the values from table 9, which are the corresponding critical values for the ADF test for co-integration, they're different. So they are much smaller. So for instance, if we use as a test regression the first one here, and we want to ensure that on the 5% level our process will be stationary, then the t-statistic of our phi, let's say we have our system of two variables, then k is 2. Yeah. So in this case, our phi should be smaller than minus 3.27. Oh no, sorry. We should go for k is 1, yeah, because we have one regressor. So it would be minus 2.76. So this guy here should be smaller than minus 2.76. And if this would be true, then our processes would be co-integrated, as the residual term of this regression equation, of the co-integration equation, is stationary. That it means that our two processes are in the long term mean reverting. Yeah? They have an equilibrium. They always come come back to a common denominator. If we would use the second model here, we have a constant term in the test equation, then our point estimator here should have a t-statistic that is below minus 3.37 in order to ensure that our processes are co-integrated. Are there any questions so far? So that's the easy way, or that's basically a standard procedure that has been derived for many years ago. And if you have just two variables or two processes that you investigated, like in this case that we have done, then this would be actually appropriate, or this could be used as well. So we do not necessarily have to learn this Johansen trace test. Even though in eViews, of course, it's simple to just push the buttons and then you get your results, but that's maybe easier to understand. But anyways, so whatever you use, we use the Johansen trace test, and what we figured out is, okay, our cross-sectional return dispersions for the equity and the currency market, they are in fact co-integrated, which means, okay, they share a common stochastic component. So the next step in our analysis was, okay, we wanted to establish a link between the currency return dispersion and momentum payoffs. Yeah? So how did we proceed? So we followed basically a paper from Stambau, and this was a paper that has been in the reading list last year. So what those guys are doing, they establish a link between investor sentiment and different asset pricing anomalies. Yeah? And what the authors are doing, maybe I can use the other board here. So the investor sentiment process, if you plot it against time, yeah, let's call inv is investor sentiment given time t, and the process looks a little bit like this. It's very similar. You know, you have periods where you have very optimistic investors. Yeah, this is basically when investor sentiment is high, and you have periods where investors are pessimistic. This is when investor sentiment is low. Yeah, high and low. And what the authors are then doing is basically, okay, they say, okay, they sort the observations of the investor sentiment based upon the median, and whenever the investor sentiment at time t minus 1 is below the median, they form a dummy that has a value of 1 and is 0 otherwise, and then they have another dummy variable that indicates high investor sentiment, so when investors are optimistic, and this has a value of 1 whenever the investor sentiment at time t minus 1 is above the median and is 0 otherwise. So it's very simple. So here, in this time periods, the one variable has 1s, then it has here 0s, and here at 1s, then 0s, and then 1s again, and the other variable is vice versa. Yeah, it has 1s here, 0s here, 1s here, 0s here, etc. So this is what they have been doing. So our cross-sectional return dispersion process looks very similar. It's also a process that is long-living somehow, right? So we did a similar thing, but we didn't sort upon time t minus 1, because this is an ex post analysis anyways. Yeah, this is an ex post analysis anyways, because you determine the median based upon the whole sample. Yeah, so it doesn't matter if you then lag it or you don't do it. So what we have been doing is, okay, we used our cross-sectional return dispersion measure, or better, the 3-month moving average, yeah, which looks very similar, and then we did the same thing. But we coded a binary variable, d1, let's call it d1, t, which has a value of 1 whenever the cross-sectional return dispersion is above the median and 0 otherwise. Yeah? So when this is high and is 0 when it's low. And we have a second dummy variable that is exactly the other way around, that has a 0 when cross-sectional return dispersion is low and the 1 when it's high. Yeah? So this one variable gives us basically the payoff, should give us the payoff for momentum when we have high economic risk, and versus the payoff when we have low economic risk. So using these two defined variables, then we have our momentum strategy, momentum at time t, and then we just regress it. Let's call alpha 1 times our dummy variable that we coded d1t, and alpha 2 times d2t, and then of course we have this error term that we have always to include in our regression equation. Yeah? So if the payoffs of our currency momentum strategy, if they are driven by this risk, or by our cross-section, or by changes in cross-sectional return dispersion, then the difference in point estimators here of our dummy variables should be different from 0, right? So this payoff should be, for instance, it should be higher when cross-sectional return dispersion is high than when it's low. So let's have a look. I made it here once again. So we have our two dummies, indicating us when the currency return dispersion is high, and or the other dummy variable indicating us when the cross-sectional return dispersion is low. Yeah? And then we test the difference in parameters, alpha 1 minus alpha 2. If it's 0, and our alternative hypothesis is that it's unequal to 0. And if we have a look here on table 4, that's basically the key table here of this paper. Yeah? So what we see is, now we consider the long-short strategy, the zero-cost momentum portfolio, and we see that the return difference between high states, so when cross-sectional return dispersion is high, minus states when cross-sectional return dispersion is low, is 1% per month, with a t-statistic of 2.94. And now we remember from our first lecture, first of all, we know already from high school these critical values of the standard normal distribution of 1.96 and minus 1.96. Yeah? So if we take the standard values, then we know already, okay, 2.94 means, okay, that the return difference of 1% per month is statistically significant, which means that when macroeconomic risk is high, respectively cross-sectional currency return dispersion is high, the payoff of momentum implemented in currency markets is on average 1% higher than in states when economic risk is low, respectively cross-sectional currency return dispersion is low. Yeah, and this return difference is statistically significant on the 5% level based upon the standard assumptions. But even if we account for multiple testing, and we remember now this paper that we discussed about the value is 2.78, because this is, you remember, this is due to data mining and data dredging, that people, this bias in scientific publication, that it's easier to publish results, than publishing non-results, so people are somehow fine-tuning their results so that they are somehow have something to report, and because of this problem, we should actually have higher t-statistics, not 9.5 1.96, but in this first paper that we discussed in this course, they were telling us we should compare the the t-statistic with the critical value of 2.78 instead. But even if we would account for this multiple testing problem, 2.94 is higher than 2.78. So it's highly significant. It's a highly significant difference in point estimates. And what we see then from long leg and short leg, we do now the same thing. We estimate this regression equation here, but then our dependent variable is only the long leg, respectively the short leg of our momentum portfolio. What we see is, to consider the short leg, the difference in point estimates between high and low state is statistically not different from 0. So this effect is driven by the long leg. Because it's the long leg that responds here. Is this clear to everybody? If not, then please ask. So that's the main idea of this paper, Table 4. Table 4 reports the main results. And also when you do your master thesis, I mean, this is something what I could imagine you could do in your master thesis as well. It's just simple regression analysis, basically. This is nothing from a methodological point of view. It's not too fancy what's going on here. But the idea matters actually most. And what you also have to do in your master thesis is, of course, you have to ensure somehow that that the reviewer or the supervisor, whoever reads your thesis, understands that your result is not a statistical artifact. It's robust to different model specifications. So that's what you also have to do in your master thesis, of course. So you can think of any scientific paper as a sort of a comprised master thesis. It has like 20 pages, 25 pages. Your master thesis has 100 pages or 80 pages or something. So a scientific paper is basically, in essence, a comprised type of master thesis, if you want. So also in your master thesis, you have to somehow to make some sort of robustness checks. You have to show the reader that what you have done is that this result is robust. It doesn't change if you make small modifications of the model. And that's also what we have done here. That's the main result in Table 4. But then, of course, people could argue, that one, people could argue then, okay, you remember we have used a 25 value-weighted global equity portfolio sorted by size and book-to-market ratio, And since our currencies are denoted in dollar, and these equity portfolios are also denoted in dollar, at the first glance, this might make sense, but then someone could argue, but your result might be driven by the dollar factor. So, okay, how can you address this issue? So what we did is just, we used 21 domestic stock indices denoted in local currencies, and then we estimated again the same thing that we have already done. And again, we find that these processes are co-integrated. So we have the same result. So our results are robust in this respect. Doesn't matter if we use 25 value-weighted global equity portfolios sorted by size and book-to-market ratio in order to compound our cross-sectional equity market return dispersion measure, or if we use 25 domestic equity indices denoted in local currencies. Both processes are co-integrated with cross-sectional return dispersion in the currency market. That's the result or the idea here in section 4.3.1. Then again, someone else could say, as I already mentioned, that you basically here in equation 1, if we go back to equation 1, Yeah, I told you in order to compound our measure of cross-sectional currency return dispersions, we used 6 portfolios sorted by interest rates. Carry, it is called carry basically. So, but then someone could say, yeah, but you should use, this process is too smooth, you should use all currencies. So, okay, we changed this measure here, we changed equation 1 and used all 39 currencies in order to compound our cross-sectional return dispersion measure. This is what the next section here is about in our robustness check section. So in section 432, we used individual currencies instead of 6 portfolios sorted by interest rates. Yeah? And the results are the same. This is what comes out in this paragraph here. Then, we know from our previous lecture, or from your undergraduate studies, you have heard about the Farmer and French two-factor model, right? Who has never ever heard about the Farmer and French two-factor model? Yeah, it's common knowledge nowadays for anyone who has something to do with finance, right? So, and we will talk next lecture. This will be the peak of our adventure. Next lecture, tomorrow, same time, same room, we will talk about the Farmer and French 6-factor model. And we will talk about the paper choosing factors. So there we will encounter basically Farmer and French, a couple of years ago, they proposed an updated version of their 3-factor model, which is called the 5-factor model. And then last year, they proposed the 6-factor model where they added this momentum factor. But we will talk about this tomorrow in detail. But it might be not surprising that people came up also with factor models for the currency market. Because you have to remember, or you have to know that the currency market is much, much bigger, at least 10 times bigger in terms of money or of turnover than the equity market. Yeah. So, and the difference between currency market or this traditional currency market and the equity market is that in equity markets we have also a lot of like ordinary people like you and me who are trying to trade some stocks or something or some certificates. But in the currency market there are big players. Okay, there are like banks and industries that are in the export industry or import industry. They have to buy and sell currencies all the time. So the big players are basically the actors in the currency market. Yeah. So and the market is much, much bigger. So even for this currency market, there's a 2011 paper from Lustig and his team, and they proposed a 2-factor asset pricing model for pricing currencies. And what they propose is basically, a model where you regress currencies on the dollar factor, which is nothing but the equal weighted portfolio of all currencies for each point in time, and this carry factor that we basically also used. So it's a zero-cost strategy which buys those currencies of countries that have a high interest rate and short sells currencies of those countries with a low interest rate. That's the carry factor. So they proposed this 2-factor pricing model for this currency market. So what we did then is, in order to address this idea, in order to check if our results are still robust, once we control for this 2-factor model, what we simply did is, we redid table 4 one more time, but we just added it here to dummy variables, these 2 risk factors, the dollar factor and the carry risk factor. So we controlled for the dollar risk and the carry risk factor. And then we redid our analysis. And this is reported in table 5. This is what you see here. And you see the regression here, actually. We have it here in our table description. Here. We account for the dollar factor and the carry factor, the first row here in our equation. So then we just redid the analysis, and then we tested again the difference between high and low cross-sectional return dispersion, and this is what you see here. So the point estimate is now increased from 1.0 to 1.03. It's only a little bit higher, but again, the t-statistic is 3. So the t-statistic is even higher now once we control for the risk factors. And yeah, 3 is much larger than 1.96 and obviously also much larger than 2.78. So the results remain unchanged. The results are robust. After we addressed this idea, one could argue, yeah, that our results might be driven by, or might be driven by formation period spread. Yeah. So of course, because the momentum payoff, obviously, it's a sort of autocorrelation. Yeah. So because those currencies that have performed very well in the past, they tend to perform well also next period, and vice versa. Currencies that have performed very poorly last month, they tend to underperform. So, and one might argue, okay, maybe the payoff of momentum is just, or our results are driven by the formation period spread. So maybe the because in the formation period, yeah, if the spread is high in the formation period, which is last month, if the spread is high in last month, the return difference, then the return difference is also high in the next month, in the forecast period. So someone could say, okay, our results are basically an artifact that we didn't account for that. So what we just did is then, okay, we compounded the formation period spread, yeah, and we added it here as a regressor in our model. And this is what we reported in table 6 here. So, and you see here, our equation becomes larger and larger here because we have more and more regressors, okay, in order to address all these ideas that one might wonder. So here we edited the formation period spread, yeah, which is the return difference of our portfolios in the previous month, yeah, the formation period. So, and what we see here is the payoff becomes even larger. Yeah, the payoff even increases. So this is, of course, driven by a correlation. Yeah. But anyways, our results remain robust because the return difference between high and low state in cross-sectional currency return dispersion is significant with a t-statistic of 4.22. So the t-statistic, it just increases. So our results show so far that when cross-sectional currency return dispersion is in high state, so under economic stress, the momentum payoff is higher than compared to economic states where everything seems to be hunky-dory in the economy and the cross-sectional return dispersion is low. But how can we show, or how can we show actually that this is true, that the momentum payoff of our currency momentum strategy is actually a function of states in the economy? So what we did is we followed a procedure that has been earlier reported in the paper from Petkova and Zhang. This is what you see here on page 217 in section 435, States of the World. So we were sorting our, or we were basically coding dummy variables. Yeah. So, and our first dummy variable, yeah, has a value of 1. Yeah. When we have a good state, state 1 corresponds to the 10% lowest observations of the 3-month moving average of cross-sectional currency return dispersion, yeah, state, and a 0 otherwise. So our second dummy variable denotes state 2, corresponds to below average cross-sectional currency return dispersion, excluding the 10% lowest observations. State 3 corresponds to the above average cross-sectional currency return dispersion, excluding the highest 10% of the observations. And the state 4, which is a bad state, corresponds to the 10% of highest observations for cross-sectional currency return dispersion. So, and then we regressed our momentum payoffs on these 4 dummies. And check the average payoffs. And this is what we see in table 7. So what we see is, and basically, that the payoffs are almost linear increasing as we move from a low state to a high state of cross-sectional currency return dispersion. Yeah? And here also, if we have not talked so much about the second measure here, but it's robust. Even if we change the measure, if we orthogonalize our measure for cross-sectional currency return dispersion, we see the same pattern. The payoffs of currency momentum is low when cross-sectional currency return dispersion is low, and it's high when cross-sectional currency return dispersion is high. Which is actually a good thing, because it tells us that our strategy, that this momentum strategy implemented in currencies, is like, it behaves like an insurance-like. It has insurance-like payoffs. Yeah? Because when the economy sucks, we earn more money than as if the economy would be in a good state. Knowing that equity momentum does not pay off so well when the economy is doing bad. Actually, at some point, equity momentum actually crashes. When we have been, this has been reported in the literature. If you're interested in that, there's a paper from Daniel and Moskowitz, 2016 paper. I think it's in the Journal of Financial Economics. It's that momentum crashes. They talk about this topic. So basically, what we see in equity markets, in U.S. stocks, it's everywhere. It's also you can also consider Finnish stocks. You will see the same pattern. So if we have a bear market, if the stock prices, if they go down, and then they move all of a sudden, the volatility increases, and then they move up again. So this is what we have seen in the financial crisis. Stock markets all over the world went down. But then, after some point, in beginning of 2009, in March and April, the volatility was super high. I think we have never in history ever seen this before. The volatility was super high, and then the stock markets moved up again. 10%, 15%, 20% per month. And what happened to a momentum strategy is, here it was, of course, high, the cumulative return. Then during the crisis period, it was like almost zero payoffs or negative payoffs. But then during the crash, but then when stock prices were moving up again, momentum crashed. Like we had payoffs of minus 80% in 2 months. So when we have this extraordinary market scenario, when we are in a bear market, and then all of a sudden volatility increases substantially and stock markets move up again, momentum or stock momentum has extraordinary losses. So we know that momentum has these effects, but obviously a good advice would be then to switch the strategy, to switch the money from the equity market to the currency market, as the currency market obviously gives a better payoff in these scenarios. So then, lastly, that I would like to discuss here, of course, if you go through the paper, you will see that we have done some more robustness checks. Yeah, this is a huge paper in terms of robustness checks. So, but in section 436, we are controlled for macroeconomic variables. So we use basically the standard macroeconomic variables that basically are used in every study. Growth of industrial production, durable consumption, non-durable consumption, service consumption, unemployment, and a dummy variable for NBER recession dates. Yeah. So, and then of course we can use this equation here. Yeah, we can use these variables here. Yeah, and then we just add it here. The equation becomes even longer if we add these variables here, and then we do the same thing all over again. Yeah. So, but of course, obviously, nothing changes, and all this is reported in the appendix, as far as I'm concerned. So, yeah, and if you scroll through the paper, you will see that there are subperiod analysis. Yeah, we do many other things here as well. So, to conclude this paper here, our tests indicated that cross-sectional currency return dispersion and cross-sectional global equity return dispersion are co-integrated. Yeah, they follow the same, or they share the same stochastic component that ties this series together. And returns on currency and equity markets are driven by the same underlying component, broadly interpreted as global economic risk. Yeah? Even though it's in its original form or in a theoretical form, theoretically derived only for the equity market. Upon dividing the sample into high and low global economic risk states based on currency return dispersion, we find that the spread of the zero cross momentum strategy is significantly larger in high cross-sectional return dispersion states compared to low cross-sectional return dispersion states. We also find that the relation between momentum payoffs and global economic risk is linear increasing in risk. Yeah, are there any questions? You can also ask questions for other lectures that we have been through already. So is there anything that you would like me to go through in the exercises? If there are not wishes, then in the first exercise session, I would like to cover, or I would like to talk with you about the principal component analysis. So the thing is, if we go back to our figure 2 in this paper here, I told you if we want to show that two time series share a common driver, a common stochastic component, and these two processes are random walks, are integrated of order 1, we say in statistics integrated of order 1. It's the same, you can say random walk, or you can say they are integrated of order 1. That's why we call this co-integrated if they are tied together. Yeah. So if two processes are integrated of order 1, if they are random walks, like here, like we have here in this picture, in figure 2, then we need to employ co-integration analysis. Yeah? So we need to do this. If we have only two processes, we can run this ADF test for co-integration. This is based upon employing the simple regression analysis, basically. But if they are not co-integrated, or if they are not integrated, if both are stationary, yeah? So if our ADF test would tell us, okay, both are stationary, yeah, both are stationary, then co-integration is the wrong methodology in order to show that those two processes share a common stochastic component. And what you would do then instead is you would employ principal component analysis in order to show the same thing. So principal component analysis basically is used instead of cointegration analysis if you are dealing with two processes that are already stationary. But you want to show that they are driven by a common component. Yeah, so this is what I would like to do with you in the first exercise session. Yeah, you have still time to express your wishes for the second session. Yeah, otherwise I might come up with something. Okay, if there are no more questions, have a good evening.